Welcome back. In this session, I'd like to take what we've talked about in terms of income statements and apply it with real companies to see how the numbers play out. But before I do that, I'd like to do a big picture perspective of what income statements look like based on where a company is in the life cycle. Remember, companies are born just like people are. They grow up, they mature, they decline, and they go out of business. So if you think about companies going through this life cycle, income statements reflect the changes that companies go through. Early in the process, what are you going to see? You're going to see high revenue growth. Young companies, because you're scaling from such a small number, will have high revenue growth. That revenue growth will tend to slow down as companies age, and then when they go into decline, revenues will shrink. Early on, companies are going to lose money. Why? Because they're not making much in terms of revenues. They have lots of expenses. As they grow up and they mature, those losses become profits. They stabilize as a company becomes mature, and as a company declines, those profits decline as well. If you look at a company's income statement, you should be able to make a judgment as to where that company is in the life cycle, though sometimes companies can reinvent themselves. So let's look at 4 companies across the life cycle. With each of these companies, rather than talk about every number in the income statement, which can be overwhelming, there are so many numbers, I'm going to focus on a few items that I think bring home the differences across companies as well as the commonalities. Let's start with Peloton. Peloton, for those of you not familiar with it, is a company that sells really expensive exercise bikes and treadmills and subscriptions that you get, where you pay a monthly subscription every month to get classes that you can take on that equipment. This was from the Peloton Prospectus at the time that they went public in 2019. It is a very young company, and here's how you see it manifest itself. When you look at revenues, notice that the revenues from 2017 to 18 double and double again in 2019. Why? Because you're growing off a relatively small number. High revenue growth. If you look at the gross profits, they look pretty healthy, even though it's a young company. Why? Because gross profits reflect just the cost of goods sold. Then if you go down to the net income, you see the features of a young company. The company is losing money. Then don't freak out. Don't say this is a terrible company. It's exactly what you should expect from most young companies. Now, one of the items that I want to draw your attention to is R&D. You're saying, so what? It's an expense? It is an expense. I'm just not sure it's an operating expense. Something we'll come back and talk about later, but R&D is an expense that's designed to create benefits over many years. It might be a little unfair to treat it as an operating expense. Overall, young companies, high growth, decent gross profits, but big losses. Let's move one step up the ladder and look at Netflix. Netflix has been around a while. It's still a growth company, but it's a much bigger growth company. It too is growing just like Peloton was, but not at the same rate. Why? Because you're building off a bigger base. In many ways, the lower growth rate at Netflix is even more impressive given the base from which it grows from. As with Peloton, there is an item that's troubling: technology and development. For those of you familiar with Netflix, that technology and development is what Netflix spends building its platform, which is where it makes its money in the long term. It's treated as an operating expense. Now, once you look at the net income, that net income now is positive. Why? Because the company is beyond the young growth phase. It's a mature growth company. At the bottom of the income statement, you see 2 items, basic and diluted. You're saying, what are those? Basic takes the net income and divides by the actual number of shares outstanding. What does diluted do? It takes the same net income and divides by the shares that could potentially be outstanding if options and restricted stocks that are not counted are counted in as part of shares. So basically a fairly conventional income statement. Before I leave the Netflix income statement though, if you go towards the bottom of the statement, you'll notice that the net income is adjusted for items that are viewed as basically extraordinary items. One of those items though shows up every year. It's the income or loss from foreign currency translations. You're saying, what is that? Netflix has foreign operations. To the degree that the dollar gets stronger or weaker over a period, its income in a foreign currency can go up or down. This is not an extraordinary item. Given that Netflix is a global company, this is going to show up. You're saying, how do you know? Well, it shows up every year. And the signs change. Sometimes it's positive, sometimes it's negative. In contrast, though, the second item, which is change in unrealized gain, shows up in only 1 year, 2017. So if you're thinking about extraordinary items, the change in unrealized gain, that one-time item that shows up in only one of the 3 years, has a much better argument for being treated as an extraordinary item than foreign currency losses or gains. Let's move one step further up the ladder and look at Coca-Cola. Once upon a time, this was a great growth company. Those days are now behind it. At best, it's a mature company, and you can see that reflected in the revenue growth that is fairly low. In fact, if you look at the 2017 to 2019 revenues barely change. If you look at the expenses, the biggest expense is SG&A. In fact, if you contrast the two expenses, cost of goods sold and SG&A, notice that SG&A is almost as big as cost of goods sold. I didn't draw your attention to this, but if you go back and look at both Peloton and Netflix, you'll notice that their cost of goods sold are much higher at least relative to revenues in Coca-Cola. Now, if you're wondering why, the answer is very simple. Coca-Cola's cost of goods sold is small. The syrup, the bottling, if they own the bottling plants, much of the cost is in the form of marketing. Its biggest asset, its brand name. To build that brand name, you're going to spend on advertising. If you go further down the income statement, you'll see an item that says equity income or loss. What is that? That reflects the income or loss that Coca-Cola makes in the subsidiaries, the holdings it has in other companies. So those are 3 items, and you can already see as you went from Peloton to Netflix to Coca-Cola, the transitions in growth and the transitions in profitability. Peloton lost money, Netflix makes money, Coca-Cola makes even more money. Now, if you look at Coca-Cola's footnotes, there's additional information that might or might not be useful when you do financial analysis. Coca-Cola is a multinational company, so it does break its revenues down by region. So I found this in the footnotes, and I'm troubled by one aspect of Coca-Cola's breakdown. If you look at the breakdown geographically, first it's into 4 regions. Europe, Middle East, and Africa. And already saying, why would you bundle Africa with Europe? But it seems to be something companies often do. Latin America, North America, and Asia Pacific. Okay. Your geographical breakdown might not be the one that I chose, but remember, you don't pick this, the company does. What troubles me, though, is in this breakdown, there's a breakdown for global ventures and bottling investments, which are not geographical breakdowns, they're business breakdowns. Some companies seem to want to do this, and it is in fact troubling from a financial analysis perspective to kind of meld together geographical and business breakdowns. There's an item also called corporate. You're going to see this anytime companies break revenues down. What are corporate expenses? These are expenses in search of a revenue source. They're the expenses of headquarters. They don't go to any particular geographical area. They apply to the company. Now, the final company I want to look at across this life cycle is Toyota. Now, Toyota is an old company. In fact, you can argue that traditional automobile companies are in decline, beset by green energy, electric car companies. You see the numbers for 2019 and 2020. Why do I call Toyota company in decline? Well, if you look at the revenues in 2020, they're actually lower than they were in 2019. Okay. You'll also notice something interesting in this income statement. There's a financing operation revenue and a cost of financing operations. What is this? Every automobile company, or most of them, have a financing business embedded, a bank embedded in the middle of a company. What does this bank do? It's a captive bank. It's actually a financing operation to allow people to buy Toyotas. It's already a little messy because when you put in a bank in the middle of a traditional company, you make it a tangled web to untangle. But that's why you see financing operations here. If you go further down, just like with Coca-Cola, you see foreign exchange gains and losses basically move from positive to negative to negative. Equity and income and affiliated, those are the cross holdings. So Toyota, you can see, if you look at the life cycle, is a company more on the verge of decline than growth, with a financing business embedded in it, clearly a multinational with holdings in other companies. Now, as you look across sectors, the first thing you have to remember is the accounting rules, at least the principles that govern accounting, don't vary across sectors. But when you look at individual sectors, there will be line items that are specific to that sector. And as you get more comfortable with companies in that sector, you will be able to make sense of those line items. I'm going to focus on 3 sectors where you might run into line items that are unique to that sector. The first is the commodity business. where the ups and downs in commodity prices can cause line items to show up in the income statement that you don't see in other businesses. The second is financial service companies. And financial service companies are a very different beast than everything else you look at. I mean, the very notion of debt, I'm going to argue, can be challenged in a financial service company, which makes it difficult to read an income statement for a bank the same way you read it for other companies. And the final one is pharmaceuticals. So with no further ado, let me look at a commodity company. This is Total, a French oil company. Again, one of the points I want to make is, hey, accounting, just because European companies follow IFRS and US companies follow GAAP doesn't mean you can't compare across companies. They have a lot in common. If you look at Total's income statement, here's what you're going to see. The first is the first line item you see subtracted from revenues is excise taxes. Why? Because with oil companies, a big chunk of their expenses, the taxes they have to pay the countries from which they extract oil, the governments of those countries. Second is exploration costs. Remember I made a big deal about R&D expenses for Peloton and technology and content for Netflix, arguing that maybe these expenses are really not operating expenses. Well, oil companies have an analogous expense. It's exploration cost. This is the cost for exploring for oil. Clearly, you're not doing it to get revenues this year, but it's treated as operating expense. The third item you will notice is non-controlling interest. You're saying, what is that? That's just another name for equity and cross holdings. Now you might say, why don't companies call it the same thing? Well, get used to it. Companies often will use different terms for the same thing. You just have to be a little creative and willing to move along with them. So that's an oil company, and you will notice that the expenses here, the exploration costs, the excise tax, are specific to the oil sector. And you should expect to see them for most oil companies. Now, Total does break their revenues down by business, but the way they break down businesses will not make sense unless you think about how the oil company is structured. The oil business, you have to extract oil first from the oil reserves. Then you've got to refine and make the oil suitable for people to buy. So there's upstream and downstream. And if you look at the breakdown for Total, that's exactly how they've broken their business down. Exploration and production, that in a sense is where you're going to be most affected by what happens to oil prices. Then there's gas, renewables, and power. A big deal for oil companies as they try to catch on to the new trend towards especially renewables and wind power. Refining and chemicals, because many of these companies have a side product from the oil business, which is the chemical business, and then marketing and services. And as with the Coca-Cola, you notice there's a corporate column, which basically are expenses that have no place to go, that are separated out. So business breakdown, and to the extent that you can use it in financial analysis, that's good to know. Let's talk about a bank. Now, the first thing you will notice when you open the financial statements for a bank or an insurance company, investment bank, is you might not see a line item called revenues, because how exactly do you define revenues for a bank? Think of an old-fashioned bank. What an old-fashioned bank does? It takes deposits in from customers. It might pay an interest rate on the deposits, and then it lends those deposits out to other people. Now, you could call the loans revenues, but that makes no sense. So if you look at HSBC, which is an Asia-based bank, it's actually a multinational global bank, you'll notice that its income statement starts with interest income and interest expenses, which actually does make sense, right? Interest income is what you take in, interest expense is what you pay out. It also, on top of it, adds fee income in and fee expenses. Why? Because increasingly banks make a side, and in fact, for many of them, this is their main business, of deals that they do for fees, other services they provide for fees. There is a line item called operating income here, but don't compare it to operating incomes at conventional companies. Why? Because it's after interest expenses. In fact, let's step back. For a traditional company, debt is a source of capital. For banks, debt is raw material. In fact, the notion of operating income and then subtracting financing expenses from it doesn't even make sense. So here's my suggestion to you when you look at financial service companies. Focus on equity income. Income to you always has to be to the equity investors. So that operating income line item, I'm just going to ignore it. It means absolutely nothing. Remember we said each sector brings its own specific line items. With banks, when you make loans, one of the things you worry about is that those loans might not be paid back. So with banks, you'll often see a provision for bad debts or writing off loans. And you see that in item 3 for HSBC is provisions and set-asides to cover those. And there's a fourth line item, which is not unique to banks, but it's a line item that sometimes will show up at companies that do acquisitions. Now, when you do acquisitions, and we'll talk about this more in the context of balance sheets, you create a so-called asset. I'm saying so-called because it's really not an asset. It's a plug variable called goodwill. Now, in the last 25 years, accounting has moved towards a position that goodwill each year has to be revisited and impaired if there's been a problem with the company acquired where the value has dropped off. That clearly seems to have happened for HSBC, at least in 2019. There's a goodwill impairment. It's one of the most useless items on a balance sheet because it's really not an expense. It's an admission of a past failure. But if you see that, that's exactly what your accountant is trying to measure. Final example is a pharmaceutical company, in this case, Dr. Reddy's lab. One thing to notice about a pharmaceutical company is its biggest expense often is a capital expense. Its biggest operating expense. What I mean by that is R&D expenses, remember for Peloton, for Netflix, and even for Total in the form of exploration costs. With pharmaceutical companies, this item becomes front and center. Their biggest capex is often R&D, and accountants treat R&D badly. They treat it often as an operating expense. So what you see as selling and other expenses for Dr. Reddy's, that huge line item includes their biggest capex. What does it all mean? Well, if that R&D is really a capital expense, the true profits for Dr. Reddy's is much greater than what you see here because that R&D expense should be written off across time. We'll come back and talk more about what to do about R&D and its separate line items. But you've already seen with an oil company, with a bank, and with a pharmaceutical company that there will be items that show up specifically to that sector. So here's the bottom line. Much is made about how accounting standards are different across the world. But remember this, accounting standards are converging, not diverging. I find it easier to compare companies today in terms of their accounting statements than 20 or 40 years ago. And while revenues can take different forms, the end game remains the same. Accountants are trying, and the key word is trying, to measure what these companies make as gross profit, operating profit, and net profit, with the one caveat that with a financial service firm, gross profit and operating profit mean very little. You should focus on net profit. So in theory, at least, you should be able to compare income across companies. We'll talk about how to control for differences, but that's at the margin. I hope you found the session useful. Thank you very much for listening.